Welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
Welcome to another episode of Defenders of Business Value. I'm your host, Ed Mysogland. And this week, we're talking to Adam Hoeksema, and he is the president and founder of ProjectionHub. And you're probably sitting there going, I wonder why this guy? Well, I've known this guy since he was in banking, and he ran a micro loan practice up north of where I'm located. And he has seen so many different types of businesses, and he launched this ProjectionHub, and I've been seeing more and more of it. And ProjectionHub is just the way it sounds. They have a service that helps buyers and sellers and professional advisors like me determine forecast performance, whichever terminology you want to use. And so I wanted to talk to him a little bit about what makes a great forecast. How do you do that? What and why? And one of the most important things had to do with working capital. The working capital is a huge part of any acquisition, and you don't want to botch that one up. So we had it was great to catch up with him, and he truly has a wonderful service that he's offering, and I'm certain you're going to learn a lot on this episode. So I'm certain you'll enjoy my conversation with Adam Hoeksema from ProjectionHub. Adam, welcome to the show. It's great to have you here.
Thanks, Ed. Glad to be here.
Well, before you came on, I always do my introductions of you and the work you do, but I never, and I say this every time, I don't do it justice. So can you talk a little bit about, where you came from? Because I've known you for a long time, and now you've got ProjectionHub. So I'm just curious to, give us the overview of Adam.
Yeah. So I studied accounting in undergrad and did audit internship and tax internship, and pretty clearly realized I did not want to be an accountant. And so ended up wanting to be more entrepreneurial. So I got a job at a business incubator in Anderson called the Flagship Enterprise Center out of undergrad. And they hired me to run this microloan program that they were just starting. And so I became the executive director of SBA micro lender called Bankable, and was in that role for about a decade. In 2012, I kind of started this side business, ProjectionHub. And
really, it's been that long.
It's been that long, yeah. So I was initially, I was trying to help our clients, our Bankable clients, we were asking them for projections and.
No. I remember that how much work you were putting into those people. I just can't. I'm embarrassed that it's been that long. Keep going. I'm sorry.
Yeah. No, so we initially, I was working on my personal taxes using TurboTax, and I thought there's got to be like a TurboTax like solution for projections. And so my brother was going to be studying software engineering, and so I asked him, hey, you want to build this tool for me? Let's try to build it together. So that's kind of how the business started. And we wanted to be a monthly recurring revenue type of, tech startup because of course, right? That's what we all want. So I fought that fight for a long time, probably about 7 years, and was still had the day job. And then, eventually I'm a slow learner. So eventually kind of realized, people don't want to pay for projections monthly, number one. And number two, Excel is still pretty good. So we kind of pivoted the business to, today we primarily sell Excel spreadsheet templates for about 100 different industries. And then we've got a CPA on staff. We do custom financial modeling, and so that's fast forwarding to today.
Rock on. Well, I owe you an apology. And I have always advised our sell side clients that, you know what, you do not want to put future earnings claims in our sims. And it seems as though that may have been the case, years ago, but it seems as though, that's almost expected now. Like here's, what we think this thing's going to do. And if you have any confidence in your business whatsoever, you should be able to put together some sort of a limited forecast that, that you can stand behind. So I do apologize. I have not been the best advocate for that, but like I said, times are changing.
Nope.
So I appreciate the forgiveness. So let's talk about projections. There's, what's the difference between a forecast, projection, and pro forma? And I guess, from both sides of the table, I mean, I think listeners know inherently what it means, but I guess from an expert doing it, what does it mean?
Yeah, I mean, and I think what we primarily end up doing in terms of the acquisition space, we are usually working with the buyer side. Mm-hmm. And oftentimes they've been provided a set of financials and they're trying to get financing. Right. And so, they're taking the existing financials, getting it into a template format. And then our acquisition template, for example, helps you kind of say, okay, what's going to change? Here's the last few years. We're gonna use those as our baseline. Now, okay, buyer, what are you gonna do better? And why? Sure. What expenses are you gonna get rid of, or how are you gonna increase revenue, and model that out. And then ultimately, I think maybe the big thing is just making sure then, based on those assumptions, that you can cash flow if you're getting a loan for the acquisition. That's what we're usually working on, is like, can you cash flow this loan that you're trying to get?
So do you dive into returns, like cash on cash returns, your normal, now let's just say your hold period 7 years, what is your future exit total return on investment? I mean, do you dive that deep, or is it more peripheral that, here's your leverage, here's what you got to make, here's the existing components of the business, and then let's see if we can build something out that, this is the most you can afford given the constraints on the criteria.
Yeah. So I would say most of what we're asked to do on the acquisition side, I think it really, again, tends to be for the lender, and it's like, and not so much about what are the returns going to look like. Now, I would say we do real estate financial modeling, and that often is like, okay, we've got, we're going to buy this building, or we're going to we're a developer, we're going to build this building. They want to know what do those returns look like after a 7-year hold period, or whatever that might be. So that's where I more often get asked to do that kind of modeling. But
and at the same time, I mean, buyers aren't, a lot of, I don't want to say unsophisticated, because that's not what I mean. I think generally a lot of the buyers are more, can this business pay me, and can it service my debt? And then way down on the list is, can it get a return on my investment? So I'm with you that let's focus on the big rocks before we start working on all the minutia and the returns. Although, as I see, it seems as though more and more buyers are becoming more sophisticated and are layering on, here's the returns, especially if they have, a sponsor, for down payments and as we move into, it's like I said, it just seems as though that the buyer pool is just improving as far as their analytics, for lack of a better word, that they're making better decisions and they're using more tools like yours, to come alongside them or support their position with sellers and talking to people like me.
Yeah, it's a good point. I think it's probably something we should add. We have in our real estate model, we have this tab that's like the investor distribution and what it would make a lot of sense to add that to our acquisition template so that you can see that too. We, certainly doable.
Well, there's a fellow by the name of Mike Adlakari out of Chicago, and he had. I know you're an Excel junkie, and I am too. Do you remember Solver? Have you ever heard the term Solver?
I've heard of that, but
okay. So long story short, you can put Monte Carlo simulations. So you can put in different criteria, and it will churn every all of these attributes or all this data. If you say I want to maximize return, it's going to build you a deal that it looks like, if I want a 45% return on my investment and I have a 7-year hold, how much can I pay or how much should I pay in order to make it work? And I love that program. I got away from it when I went to Mac. They don't support Mac, and I'm not willing to do that. But it's a real interesting deal making software. If you get a chance, or if you want the introduction, let me know. He's a super good guy. Mike Adlakari. I wanted to from a pre-sale standpoint, I want to talk about, when you're doing projections, if I'm a seller, what am I putting in there? I mean, am I consolidating my income statement, to, grouping them and forecast, grouping the expense, the expenses, or do I have all 40 of my operating expenses and forecast accordingly? What is, A, what are you including in your forecast? And B, what's the best presentation?
Yeah, that's a good question. So the way our acquisition template, for example, works is it would allow you to you could put in all 40 of those, individual expenses, but then there's a box next to it that's going to ask you from a drop down to categorize it. And you can, I think we give you like maybe 15 expense categories. So that way you got to get those 40 into 15 overarching categories. So the presentation of the financial statements or the projected financial statements is not 40 rows long. It's a little cleaner. So that's what we typically do.
So, but from a presentation standpoint, the fewer, the better. And again, I know enough about ProjectionHub to make me dangerous. One of the things that I always cringe on, and it's not necessarily a reflection of you, it's just the tuition I've paid. So years ago, there was for a business valuation, there was a program, and I was on the development team. And so I was a beta tester, and I used it for some expert witness work. And, and so this attorney comes up to me and he goes, just tell me where you got that number. And he's pointing down. He's like, just tell me this number right here. And I couldn't, and he gave me time, and I still couldn't find it. And I went back, and I mean, it was a flaw in the program. All right. And so where I'm going with that is, like, can you override your ProjectionHub templates, or are they locked down?
Yeah, so you can. we have them unlocked, and we hide tab, like we have a calculation tab that's like, this is one you probably shouldn't mess with, but it is it's fully editable. So if you want to get fancy with it, and you can get in there and change everything, but maybe at your own risk,
your own peril. Right.
Yeah.
Well, like I said, I have to but each time like as a practitioner, it's kind of like, if something's going wrong or something doesn't look right, I know where to look. You know what I mean?
Yeah.
It's like, and I speak in spreadsheet, so I'm big into that, but I do know that this projection stuff is so important. And that's where my next question is. And that has more to do with working capital. I'm really interested to hear how you're forecasting working capital, because every deal, 2 checks. First one's to buy it, second one's to fund the working capital. So anyway, to get a better working capital number is a real big thing for buyers and sellers. So tell me a little bit about how you're doing that.
Yeah, I mean, so I guess I don't know if it's the most sophisticated approach or not, but basically we have an assumption that allows you to say on average, what's your day sales outstanding, or how long does it take you to collect receivables? So you're going to make an assumption on that. If you say, 30 days, and then, anything you sell month 1, you're not going to see that cash until month 2 in the projection, right? And then same thing on the accounts payable side. We let you put in a number of days. And so it's really kind of the difference between those two. And it makes a huge difference. Yeah, I mean, it really does. I think we've seen that recently, where it's like, why do I need so much more cash? And it's like, well, you put in that it was going to take you 30 days to get paid.
No, I was at a holiday party, and we're recording this in the middle of December, but I was at a holiday party, and one of the people, because we were talking about working capital, like, what? All you do is take, 2 months of expenses, and there's your working capital. I'm like, I mean, and this is coming from, a fairly sophisticated, operation. I'm like, really? That's how you calculate working capital? And he's like, well, yeah. How do you do it? And I'm with you, Adam. I'm like, no, we gotta be more definitive and be able to, have some sensitivity, criteria on what's going to happen. I don't know what the hell you're talking about. Why would you do that? Good night.
Yeah.
So, at any rate, so what are some of the metrics and ratios that you're following? And because we're geeking out a little bit, what's your number 1 and number 2 metrics that we need to pay attention to?
Yeah, I guess again, for me, since I'm usually working on the buyer side, and they're trying to figure out what they, what they can cash flow, what they think they can get approved for, from a lender's perspective, it's usually that debt service coverage ratio. And so, that can do a lot to kind of facilitate, how much can I borrow, which kind of feeds into how much can I pay for the business, right? So, I'd say that's the number 1 thing. And then beyond that, usually when I'm like reviewing a set of projections, for somebody that, they've done it on their own, and then they want to send it to me to give it a sniff test. I'm just looking at the bottom line really, and saying, just, you're saying you're in the coffee shop business, and your profit margin is 43%, like, there is projected to be 43%. Like Starbucks is at, I don't know, Starbucks is the best operator in the world, and they're at whatever they're at, 18%, or, so how are you going to do that? So that's usually where I look to point out problems.
And I get it. As far as from a sniff test goes, I get you. So when we're looking at at doing a projection, I was telling you this before, when we were just before we hit record, and I want to revisit it, of quality of earnings. So when you're basing your projections, I'm just curious to know, because if you have bad information going in, you're going to have bad forecasts coming out. So tell me a little bit more about how the sniff test that you're doing before you start down the path of trying to foresee the future.
Yeah. And again, a lot of it is just, usually what people are asking us for is not to determine the quality of earnings, right? We're not doing that. So we are taking what they give us, but yeah, I mean, I think I always, in lending, I would always say, like, I want to look at what the tax return says, not what the internal financials say, at the very least. Because that's what the seller's been paying taxes on, and so they've if they lied on that, there's some problems there. So
we do the same thing. That's along those same lines. We have the I'm always, if I have to pick and choose, I'm going with your tax return.
Yeah.
And so is every lender. But from growth, let's talk growth, because I mean that's ultimately what's driving at least the valuation from a forecast. So business valuation is based on earnings growth and expectation, or earnings growth and risk. So where are you coming up with growth when you're doing that? I mean, is that just interviewing with the buyer, or are you going into IBIS world and looking at the industry? Where's that data coming from for you?
Yeah, I mean, usually it is going to be an interview with the buyer, and saying, I can take your historical numbers that you provide and say this is what it's been growing at, but usually the buyer seems to have an opinion about, like, no, we're gonna grow 25%, or what.
Yeah.
And so that's usually where that's coming from. In the later years, a lot of times what I'll suggest is, like, you have some specific plans that you want to make changes year one, and you think this is going to result in growth. So year one growth rate, we might apply your 25 or whatever it is you want. After that, then I'm going to go to IBIS world or look for what's the industry just growing at generically, and try to get it so that by years, if we do a 5-year projection usually, so by year 3, 4, and 5, like, hopefully we're not assuming you're going to grow at 25% forever. So,
well, like I said, especially when we do buy side work and the buyers coming along, and they have those aggressive ideas. To me, it causes me to pause, because I think it overstates the value. When you start layering, like you said, you got 25% growth, and you do any kind of income, let's just talk business value for a minute. You start doing, a discounted future earnings, and that first year is a big one. And then year 5 is also a big determining factor for the terminal value.
Right.
So I sit there and I'm like, and I always try to steer clear from the income approach. For me, I do, we're going to grow with inflation. That's the most, if I'm on the sell side, that's the most conservative way to go. And let's evaluate risk, and, let's look at a normal holding period and a normal exit multiple. And that probably, that should get the job done. But from a buy side, entirely different conversation, because, you know, on the sell side, you've got an entire pool of buyers when you're doing valuation. All right. This is, you've got different buyers that have different levels of risk, and all those buyers are going to have a different perception of value, given all things being equal. On when you have an individual buyer and you say, look, I need, this is my hurdle rate. This is this is what I'm willing to pay. Let's start talking about building out a model that makes this thing make sense. So that's kind of where I was heading with it with you're like, from me, for pre-sale versus a post-sale projection. I mean, how close are you? Because I often wonder when down the road, most people aren't pissed at me. They normally, we normally have a pretty good track record with, as far as the value guidance that we provide, but I've often wondered how close we were to the projections down the road. How do you track that, or do you have any idea?
Yeah, I don't
Like
don't
me.
really know. It's like, yeah, I mean, I think a lot of good, right, or indifferent. I mean, it's just, I think most people, what I found when they're asking for projections, it's for the lender. Like they don't want to look at it again. It's like they do it for this exercise.
Yeah.
And it's like,
that's funny. Yeah.
So it's like, I don't think I don't know. I think that's why we've realized it was hard to get people, even if you should, set us projections, look at them every month, see how you're doing compared to projections. That was like the original idea of the business, and that monthly recurring fee, but nobody wanted that. They just wanted it for the point in time.
Interesting. So where, I meant to ask you, where do you get your business? Where is it coming from? Because I mean, you're a well-known guy in this community. So you're a good practitioner. Where's most of the business come from?
Yeah, it's mostly Google organic search and YouTube search.
Really?
So
interesting. Have you thought about like Upwork and posting there? Are you familiar with Upwork?
Yeah, I've tried that a bit. There's competition there. Like, it's like, I let the business come to us when the buyers are ready. Like, we don't do much in terms of, having to sell somebody. It's like, they come to the site, they read what we have, they watch a video on how our template works, and they make a purchase decision. And,
nice.
And then if they need help customizing or filling it out, that's where we're doing our consulting work.
So what's the most popular template?
So from a dollar perspective, our acquisition template is actually our highest revenue generating, but it is industry agnostic. So it kind of works for any industry. But if you look at we have about 100 different industry specific templates. Right. That's what those are more for, tend to be more for startups, where you're you don't have historical financials, and you're just like, I've got a trucking business. How many trucks have I got on the road? Yeah. What's my rate per mile? So building those base level assumptions. Sorry, I think our most popular, like in terms of just raw numbers of templates sold, is our trucking template, actually.
Really?
Because every like owner operator that wants a loan for a truck, the bank's asking for projections, and so there's just a lot of those.
No, that's awesome. I was curious to know, whether, was there something that, you saw a lot of, and I was just curious to know whether or not, did it tie to, the number of businesses that are being sold, or the composition of the businesses that are being sold, that, you're positively correlated to BizBuySell's insight report on what types of companies are being sold. So.
Yeah.
All right. So put your forecast hat on. And so what tools and resources should buyers be utilizing or considering in order to to either use you or build their own forecast, what should they be? Is there here's everything in my toolbox that I always, or I would say you at least need to explore?
Yeah. So one of the if there's any like physical retail, physical location aspect to the business, I use a tool called Advan Research, which is a foot traffic tool. There's a couple other ones out there too that seem pretty good, but you can, put in an address for, the location you're buying,
Really?
or you can put an address of a competitor and it gives you an estimate of foot traffic. You've probably like accepted some terms and service on your phone. So that's so they can track you and put you in a foot traffic report. But I found those to be pretty useful.
Interesting.
Like I was mentioning a gas station. Guy owned a plot of land, was going to build a gas station on it. Mm-hmm. Well, I could find a foot traffic report for the gas station across the interstate on the other side. And you could even see how many people came to the gas station property, but also how many went into the convenience store.
Really?
So you could get some estimates on,
I was going to say,
convenience store sales and gas sales. Yeah.
No, that's a hero comment. I mean, you could really help somebody like avoid or make a great decision based on that kind of information. All right. So Advan. All right. What else is in the secret toolbox? No, that you can share. I'm sure you've got.
Yeah. And so those are physical. I like that for the physical businesses. For things that are more website, driven, or I often use Ahrefs.
Sure.
Which is
for web.
Yeah, so I can put in any website in there and get an idea of how much organic website traffic they're getting to their site. And so what I like to do with both of those is it's the sniff test of, okay, if I think I need I need to have 1,000 unit sales a month, and I think I'm an e-commerce and I think my conversion rate's going to be best, at 3%. I can kind of back into how much traffic I'm going to need. Mm-hmm. So then I could look at some competitors or look at the website I'm considering buying and say, okay, am I close to what kind of traffic are we? If my best competitor has less traffic than that, boy, how am I going to make this work?
Interesting. Yeah.
So
I'll tell you one of the things that I think is a totally underutilized resource that I after the pandemic, I mean, is your public library. Or I do some teaching at Butler, and you probably knew that, but I'm telling you what, the access to some tools and periodicals and some industry research that otherwise would be pretty cost prohibitive. I mean, if you're in a particular space, it's one thing, but when you in our practice, I mean, we've got different silos, but generally speaking, we're a generalist. So being able to bob and weave and pick things up from, different industries, we go, like I said, we go through the public library, and especially, where I live, whether it be the Indianapolis Public Library or the Carmel Library, I mean, those are some robust operations. So yeah, so I think I would add those to the short list.
That's a good idea.
All right. I wanted to talk to you about an article you recently authored, or a post that you put on LinkedIn about the future of business sales. You want to talk a little bit about what prompted you, a projection guy, to start writing about business sales?
Yeah. So I was, I've been hearing on, LinkedIn and Twitter about everyone talking about, the silver tsunami and all these people that are going to be retiring and sell their business. And so I was just curious. I had seen some reports from like Biz Buy Sell about the number of businesses sold on their platform, and then I had also read there was a report done by Live Oak Bank that they had surveyed a bunch of businesses and, estimated, I think it was in the like 2.2 million businesses that they thought wanted to transition in the next 5 years. So I just did some math. If you just divided 2.2 million by 60 months, it was like 38,000 businesses that needed to be sold every, or transition every month. And so I was trying to find a source, and maybe you know of a source, but I was trying to find a source like how many businesses sell from all sources in a given month. I looked at Biz Buy Sell, and I looked at the SBA loan data to see how many businesses were sold with an SBA loan, and it was like 7,500 a year. I mean, it's not very much.
Right.
So the total between those two and the sources I found was like maybe 20,000 a year.
Yeah.
And you need to be at 38,000 a month pace. so that just kind of brought me to this, like, there's what am I missing? Or
you're right. So, and to begin with, so one thing, I don't want to dog on Biz Buy Sell, but I will. I mean, they list, I don't know, between 50 and 60,000 businesses a year. Okay. And if you pay attention to the insight reports, I mean, they only sell about 10,000. So, I mean, you can see, the dismal return. And that's what, why I'm, working on launching, Biz Sale by Owner, the self-directed business sale platform, because I think a lot of people they need more, because all those 60,000 businesses aren't represented. Somebody needs to come alongside like you on the buy side. This is how you do forecasts. Now let me show you, let me help you. And I think that there's a lot of value guidance challenges and different things like that. But to answer your question, so I did some analysis too, and I'll send this to you, that, there's 12 million business owners that there are businesses that are owned by baby boomers. All right. 78% intend to fund their retirement. All right. 60 to 100% of their retirement. All right. And it's 18 years. All right. 18 years is the average retirement. And you don't have to write it down, because I'm going to get this to you.
This is great stuff. I'm writing it down.
So eight, and I'll give you I'll cite you the sources, but 8 million will go to market. All right. If you use the 20% success or sell ratio, that's 1.6 million businesses will sell. All right. 1.1 will simply close the doors. And then 5.3 are hanging out there. All right. And they may not sell. And here is the value, or the reasons. And again, for those of you listening, I mean, I'm mixing and matching some data, but it's the best data that we have. All right. So 10%, just weird things happen in deals. That's why it won't close. 10%, there's no market. 11%, it's because of lack of capital. Another 11% is insufficient cash flow. 12% fail because of economic uncertainty. 20% because of unreasonable demands, and 26% is value gap. That's kind of the donut of why the 5.3 million won't sell. And so, and then out of those 12 million, again, we've got 4 million that will attempt to transfer to family members. So that's the data. And like I said, I haven't cited, the information I just quoted was from Pepperdine Private Capital Markets survey. So I will get that to you.
Yeah, that's great.
Well, but to for our conversation, I guess I'm curious to know. I mean, you've been in banking, you've been in accounting, and now you're doing projections. I mean, where do you see this thing going?
Yeah, I mean, my thought in that post and what I've kind of been trying to think through is that it seems like there's an opportunity for on the buyer side to um, be more creative and
Mm-hmm.
and like because there's going to be a lot of supply. There should be a lot of supply in businesses that would be interested in selling. And so I guess I've been thinking, and I did a little looking at Google. I like to look at Google search trends,
Yeah,
and um, I noticed like seller note. It doesn't have a ton of volume, but it's
it's
going
getting
up.
there.
It's going up. So I'm like, is that end up what happens? People try to sell it, they can't. Then eventually they're like, okay, I'll just do a seller note for a big chunk of this.
Well, it's funny you say that. So the other side is that the seller note is bridging the gap, is serving as almost the mezz debt for the deal. So when you've got 11 or 12% cost of capital on SBA loans, you've got to have some means. If you want your value, you're going to have, there's only so much borrowing power. So let's put that note, either a self-canceling note or something that might get that business owner to a premium. But I'm with you. The creative side of deals. I think it's even going to get even more creative. I think there's a lot, especially with like I said, I do some teaching at Butler, and I mean there's a lot of kids that want to sidestep getting jobs and go right into owning a business, which is you know, like, I have two daughters. One's 21 and one's 18. And I'm sitting there going, could I see my 22-year-old saying, Dad, I'm going to go run a business? I'm like, how, that from a deal guy? Yeah, heck yeah, let's go do that. From a, chances are the sponsor of the acquisition. I'm like, ooh, that might be a little rough. Um,
Yeah.
but at the same time, a lot of these kids are sitting here saying, you know what? This business doesn't have a website. Imagine what I can do layering some tech on top of it,
Yeah. Yeah. I have a question along these lines I'm curious your take on. So
Mm-hmm.
as I've been researching this, it seems like that the vast majority of like on Biz Buy Sell, I think it was like 84% of the businesses sold were for $1 million or less.
Mm-hmm.
And as I've been kind of thinking through the math on selling a really small business, it's tough to probably make the math work a lot of times, which maybe that's part of your for sale by or
Yeah.
business sale by owner
Uh-huh.
is because it's hard to afford a
Yeah.
brokerage fee or whatever it is for a $200,000 business.
Yeah, 100%. As I mean, there's a number of different reasons why somebody wants to do a self-directed sale, and the one is economic, two is ego. Like screw that,
Yeah,
I've been selling, I could sell this thing all day long, and
yeah,
they might be able to do it. Um, but at the same time, I think that there is a lot of people that, um, especially on the small side, there's a family associated with that business, and there may be only one employee, and that employee has a family, and somebody, the risk associated with closing down. I've been doing this so long, and I guess I'm to the point of I want to contribute to the industry, that there needs to be some marketplace somehow, some way that can facilitate the self-perpetuation of entrepreneurship. And that guy with the the $200,000 business is just as important as the 20 million, and where you're going to have a cadre of advisors encircling that business owner. I just want I want the same, I don't say the same attention, but the same access to best in class advice
Yeah.
At the small level. But yeah, I think it's going to be I think it's going to be a slog to turn the deal making industry that way. You know, I just don't want to see small businesses evaporate. Yeah, but again, that's all right. I need something to worry about. I'll keep doing it. So my last question is, you know, I asked this of every one of our guests, or my guests, that, you know, if you had one piece of advice that you could give them that would have, you know, the greatest impact on value or sellability, what would it be?
Yeah, I feel like I'm coming at this from, I've not sold
It's okay.
a business myself, so but I think from the perspective that I'm seeing, I think that we see a lot of the small business owners, they're just trying to not pay a lot of taxes. It's like, I'm trying to, and I saw that a lot at Bankable too, where it was like someone was trying to get a loan. Yeah. The buyer's trying to get a loan, and they say, well, here's what the seller's tax return said, but we think actually it does better than this. And it's like,
yeah, well, sure it does.
That's like tough. We can't, what can we do with that? So I think that's the, I feel the tax side as the business owner. It's like, what expenses could I cram in here? And then, in the last 15 days of the month of the year, and reduce my taxes. But if I ever want to sell the thing, I'm shooting myself in the foot. So
transparency and clarity of taxes. Yeah. Pay your taxes and you're going to reap the reward on the back end. Right.
Yeah.
I get it. So my friend, where can people find you?
Yep. So our website is ProjectionHub.com, and I've been posting more on LinkedIn lately, trying to diversify a little bit away from all of our eggs in the Google and YouTube basket. So, yeah.
Well, I will have access, or I will have everything connected to the show notes so people can find you. So, great. You know what? I'm sorry it's taken us this long to reconnect, but I sure have enjoyed our time together.
Yeah. Thanks, Ed.
All right.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.